Hello, everyone, and welcome to the Money by Chris podcast. I am Chris, and we're here talking about your money, namely your money in retirement. Thank you so much for joining us. This is episode 3 of the Money by Chris podcast, and I'm starting to get a little more comfortable with this whole process. So we're glad that you are here with us enjoying the process. Episode 3 is going to be talking about something that falls directly in line with what I do every single day. I am a retirement income specialist and I help people roll their 401k into guaranteed income or passive income streams so that you have income in retirement. And that's a common thought. It's a common concern for a lot of people, especially when they start getting near retirement. I usually start seeing people think about it around age 45 or age 50 when they start thinking, okay, I'm not going to be working forever, but I'm still going to need income. I'm saving for retirement. I've got a good nest egg saved up, but what I need is income that's going to consistently be there for me to support my lifestyle, pay my bills, pay for food. And I don't know exactly where that income is going to come from. Yeah, there's Social Security, but that's not enough to live my lifestyle. I need an income stream that I can count on. And that's what I help people do, namely with their retirement savings, their 401k, because we don't want to work anymore. And at some point, we're going to get to a certain age where we potentially cannot work anymore. So we need that income stream to be there to support us when it's time for us to stop working. I talk about this extensively in my new book, The 21st Century Pension. That's going to be released this autumn. And we hope that you reserve a copy. It's going to be available on Amazon and several other bookstores that you'll be able to order. You'll be able to get it on my website, retrieverfinancial.com. Just go there, find it. It'll be right there somewhere on the first page. Just click there and it'll be led to your purchase screen. You'll be able to order that, have it shipped right to your door, and you'll have some nice, boring reading material for you when you have trouble sleeping. You can just open that book up, read a couple pages, it'll put you right out. I'm not to say that I'm boring or my subject matter. It's what we talk about. It's just a boring type of conversation is talking about interest rates and margins of return and income stream and insurance products and investment products. It can be very boring, but we actually have a lot of fun doing it because we're planning your retirement. So when you like to travel, if traveling is your thing, or if there's something that you really look forward to doing in retirement when you have the time to do it because you're not working anymore, that's what we're funding. That's the lifestyle we're building, and we're putting together income streams so that we can afford to do that when we retire. That's the fun part. So, yeah, we're setting up this element here so that we can fund our lifestyles, but it's the lifestyle. It's the ability to go out and have fun and do the things that we want to do. My thing, what we like to do is we like to travel. Travel is Nancy and I. We like to travel, and every year we like to go someplace. We have two types of trips. We have trips, and then we have vacations, and those are different. What we define as trips and vacations, and one is called a trip. A trip is where you go with the intent on getting 20,000 steps a day. That's a trip. So if you think about going to some place like Italy or England or Morocco or Japan or China, someplace where you're going to do a lot of walking around, a lot of exploring, a lot of sightseeing, and places where you're probably not going to take very much public transportation, a little bit, but not much, or not many taxis. You're going to get a lot of steps. Those are trips. That's what a trip is. And we try to do one of those trips every single year. Then there's a vacation. Vacations are different. Vacations are designed for you to not get 20,000 steps, far less than 20,000 steps. This is going to be primarily beaches. We're going to go to a beach. You're going to go to a resort. You're not going to be moving about a lot. Very chill, very relaxed. Maybe a cruise, something where you're just not moving and doing anything at all. A true unplug, if you will. That's a vacation. And what we try to do every year is we try to have one vacation and one trip per year. So one trip where we go someplace where we intend on walking around and doing lots of stuff, and then one vacation where we plan on doing nothing. That's the kind of lifestyle we want in retirement, and we need income to be able to support that kind of lifestyle. So if that's your picture, if that's your idea of retirement, you're not alone, because a lot of people feel that way. A lot of people have the idea of, I want to travel, or I want to be free to move around because I have family all over the country. I have some clients who purchase RVs, or they have like Airstream type trailers where they go around and they go over to this part of the country, maybe in the north during the summer to visit family, south during the winter to visit family. And that's a common uh, practice that I see a lot with my clients. So, whatever your lifestyle looks like, it's going to require income to make it happen, income to fund it. Where does the income come from? That's what I help people do. And this episode, episode 3, we're talking about passive income in retirement. We're going to cover a couple of ideas, places where passive income can be received. And we're also going to talk a little bit about the difference between passive income and guaranteed income. Passive income, what exactly is that? What are the pros? What are the cons? And guaranteed income, what is that? What are the pros and what are the cons? So get ready for episode 3, where we're going to dive into passive income streams in retirement. Get ready. All right. For passive income, let's talk about the difference between passive income and guaranteed income. Well, there's three kinds. There's wages, passive income, and guaranteed income. Wages is you go to work, you do a job, you earn a salary for it, or you go do a job and you get paid for it, trading your time for money. That's a wage. Passive income, we've all heard about it, and that is where you do a little bit of work for a lot of money. In comparison. Everyone has a slightly different definition of what passive income really is. Here's mine. Here's what I define passive income is full-time pay for part-time work. Really, that's my cleanest definition of passive income. Full-time pay for part-time work. And one popular means of passive income, especially in retirement, is owning rental property. Owning rental property is a common means by which I see people say, I'm going to put together passive income. I'm going to buy a piece of property, then I'm going to move a renter into it, and that rental income will be higher than my income to, or than my expenses to maintain the property. Boom, I've got passive income. Some people will define passive income as income while you sleep. And I say, okay, technically yes, but really what it is it's full-time work, I'm sorry, full-time pay for part-time work. Because with passive income, there is a level of work that's involved with that kind of passive income. So let's say you want to be a rental property owner. There are some there is some work that you'll have to do. You might say, okay, well, how do I get the renter in the property? Well, they'll have to hire a real estate agent or someone to do the renting of the property, unless you want to do that yourself. I know some people who manage the rental applications themselves. They get their real estate license and they manage their own access to MLS, and they manage their own rental ads. Say they run ads for rent property for rent. Maybe they'll share that with some other realtors. and they'll manage that process themselves. But that does require work. Some people will say, okay, I'll maintenance the property myself, or I'll manage that as far as I get a phone call, hey, a light bulb busted. All right, I'm going to send a repairman to go change the light bulb or something. There's that work. So there's a little bit of work involved, but you're getting full-time pay. You're getting 2,000 a month or 3,000 a month or whatever that monthly income is. And a lot of people like that. A lot of people feel very comfortable with that manner of work. Some people want it to be very hands off. Some people will hire a property manager that'll do all that work for them. You have to pay them, of course, but they'll hire a property manager. The property manager takes care of all the phone calls from the renters, takes care of all the uh, exchanges from financial insurance people for the property, handles all of the real estate transactions. So if you have a realtor who's rented the property and now you have to pay them a commission, they handle all that. There's for a fee, of course, but you can't hire a property manager. And usually people will hire a property manager for once they have two or three properties or so. Now there's more than one to manage. Let's do that. I have many clients who have rental property, and that's one element of retirement income that they have. But it's not guaranteed. The income from rental property is not guaranteed, meaning something outside your control can happen that would interfere with the income that you receive from your rental property. For example, a bad renter. You wind up having a renter that turns out to be a bad renter. Anyone who has owned rental property for any period of time will usually have a bad renter story, either one that's happened to them or one that's happened to someone that they know. Someone moves in and maybe they pay rent on time, but they tear the property up. And when they move out, you walk in and realize, oh my gosh, this place is destroyed. And uh, it's not rentable, not like this. The holes in the walls. They had large animals, maybe that tore up the floors or the baseboards. It could be infested with some type of flea or insect. All kinds of possible damage that can occur from a bad renter. And now, not only is it not rentable, so your income stream is stopped, but now you have to come out of pocket some cash, 10,000, 20,000, maybe $30,000 to rehab the property so that you can get it back up to rentable state. So with an income stream that's passive like that, it's nice to have, but it's not guaranteed, and there's no insurance really for a bad renter. There's no way to insure against that. You essentially have to self-insure. So you always have to have a pile of money off to the side for when that occurs, for when you have a bad renter or something like that. Of course, there's other things like the property going empty for a while, but if you have a good real estate person or a good property manager, it usually won't go empty for very long. That's a popular means of passive income in retirement. But I'm going to talk today about some other means because I have some clients who come to me and say, Chris, I own three or four rental properties for retirement, and they're either mostly paid off or all the way paid off. So I'm earning good income, but I don't want to manage the property anymore. Or the cost to manage the properties has become a bit much. I think there might be something better. Maybe I can make more money and work less doing it, which is my whole work motto anyway. What do you got? Chris, what do you got? That's what we're talking about today. So, option number one is another means of passive income, requires a whole lot less work, and that is dividend paying stocks or dividend ETFs. Did you know that there are stocks that you could own in big companies that pay dividends? Stocks such as Coca-Cola. You could purchase stock and own stock in Coca-Cola. And those stocks, there are certain stocks that pay dividends. Owning stock is one thing, but owning stocks that actually pays you dividends is a strategy a lot of retirees look at. They sit down with their investment person and they say, okay, if you had $500,000 saved for retirement, or if you had $1 million saved for retirement and you needed a stream of income, what would you do? Some financial advisors would say, I would purchase dividend paying stocks. Not all stocks pay dividends, but some of them do. Many of them do. And talking to a financial advisor, you'll be able to get a rundown, a list of companies that pay dividends, companies that pay you a dividend for owning the stock. Of course, the more stock that you own, the more dividends you get paid. It's based on a percentage. And you can take a look and you can say, what's the percentage? And they'll tell you. They'll tell you this stock is paying this stock is paying this, and this stock is paying this. Okay, well, how does that work? You buy the stock, and then as a shareholder, typically every quarter you earn a dividend. Every quarter they pay a dividend. Some stocks will pay every year, where once a year they get together and they pay out a dividend, a percentage based on the stock that you own, based on the dollar amount. And that makes it real nice because now you're like, wait a minute, I don't have to work for that. I buy the stock, the company, they do their thing, the thing that they've been doing forever. They do that, and then as a stock owner, I get dividends. I still own the stock, and I was paid a stream of income, a dividend from owning that stock. So now my money's over here in the stock, and I'm getting paid a dividend. Typically once a quarter, sometimes once a year, but that is sometimes sufficient. The percentage. The percentage range of income can sometimes be the average range is between 2% and 5% of money. So if, let's say, you've got $100,000, let's say, that you put into a stock that pays dividends, you could expect somewhere between, on average, $2,000 to $5,000 for the typical dividend for the year. Uh, there are some that pay a little bit more, some that pay a little bit less. So if you have $1 million you put into a stock like that, $20,000 to $50,000 worth of dividend income is a potential for you. So that's one option. What are the pros? Okay, so why would someone do that? Why would someone buy a dividend paying stock, put their money in that? One reason is because there's no work. One pro. One pro is that there's virtually no work to do. The larger the company is, the less work you would have to do. In fact, there may be a shareholder meeting that you can attend, but outside of that, just to know what's going on at the company. But it's certainly not a requirement, not in most cases. And the ability to be able to just purchase a stock, sit back, and wait for the dividend checks to come in is pretty nice. So, one pro of buying dividend paying stocks is you have virtually no work to do. So, that's about as passive as income can get. So, when you talk about passive income being making money while you sleep, that's probably the closest means to doing that is owning a piece of a company that's got their systems and their processes all figured out, and you just get paid on it. For ideas on companies that you want to that you want to work with, you can contact your favorite financial advisor, whoever that may be, and they'll be able to give you some ideas. But dividend paying stocks or dividend ETFs, those are uh, idea number one for passive income in retirement, rolling your money into a stock, and that stock is designed specifically for paying dividends. What's the downside of that? The downside of stocks, dividend paying stocks. The downside is that oftentimes the income that you receive isn't guaranteed. It's very likely to happen, but it's not guaranteed, meaning that there are instances where you can purchase stocks from a dividend paying company. And then, for one of a variety of reasons, the board of directors meets that year and says, "Okay, guys, we can't pay dividends this year. We can't pay them, so we're not gonna." So that is possible. That can happen with uh, dividend-paying stock companies. Board of directors can come together and say, "Listen, we've had a rough year. Something bad has happened. We've had to make a pivot, and because of that, we can't afford to pay our dividends to our shareholders." Some companies that do that will say, "Okay, we can't pay you this time, but we're going to pay you next time. For the next rollout, we're going to make up for it. So you're still going to get your money for this quarter, just not right now. You're going to get it later." Some companies will make up for it down the road. Other companies will not. It just depends on the type of stock that you're buying. Some companies will say, "We can't afford to, and we're not going to make it up. So no one's going to get paid this quarter because of one reason or another." That could occur for much of the options, much of the stock that's out there. So that's one con, one downside to that stream. It's not for sure guaranteed. Another aspect of it being not guaranteed is that rate could change. So one year, or let's say 1 year, you get X amount per quarter. The next year, it could be a little higher or it could be a little lower because the rate is different. So the amount that you receive from your dividend could be different from year to year. Um, yeah, so that's one downside to that. Another downside that some people look at is they're fearful of what the stock could be valued down the road. They could say, "Well, what happens if the stock value drops?" Now, some people who don't have a whole lot of experience in the stock market might say, "Well, yeah, that could occur, but if you buy stock in a company that's big enough, you should be safe. You should be okay." For example, Coca-Cola being an example. If you buy stock in a company that's big enough, it should be safe. So even if there's a downturn, it'll probably bounce back. Okay. Well, that could be some logic that you could follow, but let's take a look at an example. Let's take a look at a company that you might know well. This company is called Citigroup. You might have heard of Citigroup. They're a large financial company, and they have credit cards. You might have a Citi credit card. Maybe you have a mortgage with Citi or some other type of line of credit with Citigroup. Their name is Citigroup Inc. We can take a look at their stock values. There was a time before the mortgage crisis of 2008 where their stock value was over 500. In fact, it was as high as 550, 550-ish back in December of 2006, all the way up to May of 2007. Their stock was as high as 550, $550 per share. Then the mortgage crisis happened in 2008. Their stock value plummeted all the way down to as low as $10 per share in 2009. Now, is Citigroup still around? Of course they are. Is Citigroup financially healthy? Depends on who you ask. But let's take a look at what happened to the stock price after that 2008 crunch. A lot of people say when you buy a high value stock, if it takes a downturn or if it takes a dip because of market reasons, it'll bounce back. The stock market always bounces back. The S&P always does. In fact, it's commonly bounced back. So you should be okay, right? Well, when Citigroup dropped in 2008, everybody was waiting for the bounce back. It really hasn't happened. Rolling forward 18 years, the stock price has never really recovered, not to the 500 level. Now it's gone up from the $10 that it was way back in March of 2009. It's climbed. By 2011, it was up to $40. And it stayed around $40, $50 for the better part of a decade. 2016, it was up to 50, climbed up to 80 in 2018, it was up to 60, hovered around $60 in 2020. COVID happened and it dropped a little bit, but it bounced back. Hovered around $80 for a little while. Now it's on a bit of a run. As of July of 2026, the stock price is over $100. But the point here is that if you had, say, $1 million in your retirement savings and you purchased Citigroup stock, and you purchased that in 2007, let's say, and then the price dropped in 2008 with the mortgage crisis, you've been waiting 18 years and the stock has never bounced back. That's an example of a large company, a very large company that had a high stock price, and that price was devalued and it never really bounced back, or at least it hasn't to this point. It stayed flat for the better part of a decade, and only recently, and it started climbing above $80 recently in 2025. So we're starting to see a climb back. But again, had you purchased back when the stock price was $500 or $550 back in 2007, you would have an interesting story to tell about the value of your retirement account. So that's one example of the risk of buying large amounts of one stock, because something like that, even for a big company, even for a big, strong company that is still around, they're still in existence, but their value has dropped and it never really recovered. So what that means for a stockholder is there is a risk when you put money into a stock like that of tomorrow something happening in the news and now your stocks are starting to drop in value and they never really rebound. That could occur. There's always that risk. So that's idea number one, dividend paying stocks or dividend ETFs. Idea number two is bonds. Putting your money in bonds, treasury bonds, municipal bonds, corporate bonds that provide income. It's one way that you can put your money someplace and live on the interest. Interest rates are higher these days. So naturally, bond rates are based on the current interest rate environment. And right now, interest rates are higher than they have been 4 and 5 years ago. Interest rates started to go up. If you're familiar, if you keep an eye on the news, interest rates started to go up in about March of 2023. So rates in 22 and in 21, they were still low. If you were looking in the market for a mortgage or a new vehicle, rates were lower back in 21 and 22. In March of 23, the rates started to climb, and that's when we started to see interest rates growing for mortgages get into the 6 and 7% range. They've dwindled a little bit since then, but they're still high. Having high interest rates is bad news if you're in the market to borrow money, say for a house, but it's good news if you have money to lend. And that's essentially what a bond is. When you give your money for a bond, you're essentially giving your money to the entity that is issuing the bond. And they offer you a rate of interest in exchange for that. Some bonds can be very short. Some bonds can be as little as 1 month. Other bonds, they can last multiple years. They can last, you can get a 1 year bond, you can get a 3 year bond, a 5 year bond, 7 to 10 year bond, lots of different bonds that you can buy. And the benefit to buying a longer bond is you lock in whatever rate they're promising you for the bond. Some bonds have rates that move around as far as what they'll issue, but that's the benefit to a bond is that you can lock in a rate of return. Uh, Current rates are what they are. So the good news is in this day of the internet, you can shop around for whatever rates you like, but talking to a financial advisor or a financial planner can give you some insight. They might have access to bonds that aren't as easy to find, or they usually have access to a large variety of bonds that they can whittle down for you into a small menu of 2 or 3 or 4 choices based on what it is you're looking to do. They can also give you some positives and negatives between treasury bonds versus municipal bonds versus corporate bonds. And so they'll be able to give you some pros and cons of those different types of bonds and, of course, the current rate. And they can talk with you about how long you're interested in locking a bond up for, as far as uh, years, number of years that you're looking for. So those are some options as well, bonds. Another option that we talk about, actually, let's talk about the bonds real quick. So pros and cons of the bonds. The pros is that the income is guaranteed. It's as strong as the entity that's issuing the bond, whether it's a government or a corporate, but it's guaranteed. It's a contract essentially that you're buying, and that contract states that you're going to get this rate of return. So it's a guaranteed number. And another positive with the bond is that your investment, the principal, the dollar amount, is protected. So when your money is in a bond, it's very, very unlikely that your value will drop. So there is some safety with those bonds, again, depending on the entity that issues the bonds. Governments can fail, corporations can fail, municipalities can fail. It's possible for all those entities to run dry of money, but it's, again, not very likely. So what some people will do is they'll put at least a portion of their money into bonds to help give them some manner of guarantee, some manner of stability in their retirement income. Current rates, again, somewhere bobbling between 2 and 5%, depending on what type of bond it is, how long it goes, things of that nature. Then we have a very popular means of guaranteed income that a lot of people are looking at in 2025 and 2026, and that is annuities. Annuities are an insurance contract that utilizes bonds, but now you have the backing of an insurance company. And an insurance company can stretch the ability of what a bond can do. So when you buy an annuity, you're entering into a contract with an insurance company. You're going to give them your money. They're going to take that money and they're going to put it into a bond for you, but they're going to offer you some additional guarantees on top of what that bond is. So buying a bond, that's easy. But having an insurance contract can provide you with something different. It can provide you with more guarantees that people are looking for, namely in retirement. So let's say you purchase an annuity of, let's say for 5 years with a guaranteed rate of 5%, let's say. Now, you could do something similar with a bond, but when you buy it from an insurance company, now you have the backing, the credit rating of the insurance company that's issuing the annuity, not just the bond. So now you have a carrier that's saying, we're going to pay this amount of income. Many of them will allow you to withdraw that interest. So you'll get interest paid once per year in that, whatever that interest rate is, and you'll be able to lock that rate in for a period of time, let's say 5 years. So let's say you're 60 or you're 65, you're about to retire, and you say, okay, I'm 65 years old, I'm going to start my Medicare, and I'm going to turn on Social Security. And so starting my Medicare means I can leave my employer and I'll still have medical coverage for Medicare. Okay. Medicare is going to cost me $200 to $400 per month. Okay, I can swing that. And then you've got your Social Security. Okay, I've already gone to SSA.gov. I know what they're going to pay me starting at age 65. So 65 is my target date for retirement. Leave my employer, jump on Medicare, turn on Social Security. Okay, now I've got $1 million in my 401k. I want to roll that. What do I do? You can roll that into a multi-year guarantee annuity, and that will pay you a guaranteed rate for X amount of time. That's what I call, in the annuity world, it's what I call door number one. Door number one is where you roll your money is protected from stock market drops, it's guaranteed to be there, and it pays you income or it pays you an interest per year. Today in 2026, those rates are about 5%. Somewhere in that neighborhood, give or take a few points, about 5%. That is current rates in 2026. So if you have $1 million and you're looking at $50,000 per year, that's what you need on top of your Social Security and for your Medicare. If that's what you need to live comfortable, that might work. That might work out well for you because now that money is guaranteed, not just by the bond, but by the insurance company. So now you have the claims paying ability of the insurance company backing your retirement income. So now your million is preserved, and every year $50,000 gets added to it based on whatever that rate is. If you're assuming a 5% rate, and then you can withdraw that 50,000, add it to your bank account. Good. Now we have 50,000 that we can work with. We have our Social Security. Maybe you're married, both of you are drawing Social Security. Maybe your spouse has their own 401k. They roll it over into the same type of thing. They're getting the same type of interest. That could be comfortable. That could be comfortable enough for you. That's an instance. Door number one is where the traditional old school, stick your money in the bank, live off the interest type of plan. So that's door number one with the annuities. There's other types of annuities as well. And the reason that matters is because door number one, those multi-year guarantee annuities, the rate's not guaranteed for anything beyond the guarantee rate. So let's say you buy a 5-year multi-year guarantee annuity. You're locking in the rate for 5 years. But starting year 6, the rate could change. And those annuity contracts are based on current interest rate. 5 years ago, those rates were 3%, about ish. Now they're 5% ish. 5 years from now, would they be higher? Maybe. Would they be lower? Could be. It's all dependent on the current interest rate environment of the time you enter into the contract. So right now, for people who are entering those multi-year annuities, guaranteed annuities now versus 5 years ago, they're happy with what they see because interest rates are higher than they were 5 years ago. So right now they look attractive. 5 years from now, though, we don't know. We don't know what the interest rates are going to do. If they go up, it might look good. If they go down, it might not. So that's the negative of the multi-year guarantee annuity is we can guarantee protection of your principal, but we can't guarantee the term, the rate. We can guarantee the rate for a specific term, like 5 years, but beyond that term, the rate could go up, but the rate could go down. So that's one type of annuity that one can look at. for passive income. In that instance, it's not technically income, but the rate of return is guaranteed for that period. So your money is guaranteed and the rate of return is guaranteed for that period. Let's say you're more comfortable with the rate of return that's locked in forever. Let's say you're the type of person that says, okay, I want to lock this in, but I want it locked in for the rest of my life, no matter what happens. So if rates go down in the future, I don't got to worry about it. And if rates go up in the future, well, that's fine. But for this pile of money, I want to lock my return rate in forever, no matter how long I live, for the rest of my life. That would be an income annuity, an income producing annuity. It's a different type of annuity contract, but similar. So that type of annuity contract is where you give your money to the insurance company and then they in turn start refunding you. They start an income stream for you. They take that money and they start paying you a rate every single month, every single year. And once you turn on that income is there, guaranteed every month on time, without fail, right next to your Social Security check. It's very comforting and for a lot of people. And for a lot of people, they consider that their pension. Pensions went away a long time ago, back in the 80s, and they were replaced with the 401k. And so now people have a 401k instead of a pension, which is a good thing because now people can work for 4 or 5 years for one company. They get a better offer at some other company. Now they can move to that other company. They can take their retirement savings with them. Back when our parents and grandparents had pensions, you had to stay with one company for 30 years to get it. But now you can move your 401k with you. So I have clients all the time who have two or three or four old 401ks from old employers that were left, that they took it with them when they went and they left that employer, went to work for another company. So those are all good things. But when it comes time to retire, it's now up to you. It's your responsibility for taking some or all of that money and rolling it into your pension income. And that's what we're talking about today is the passive income streams. That's one of them. One of them is an annuity that pays guaranteed income. Current rates for income annuities, if you're over 60, are about 8%, 8%-ish. Current rates in 2026, about 8%-ish. So if you give your money to an insurance company, say $500,000, let's say you give that to an insurance company in exchange for an income paying annuity and you're over 60 years old, that income, it would be somewhere in the neighborhood of $40,000 per year, about 8% or so. $1 million, about 80,000 per year ish, ballpark. So it's a little higher. And so that's what a lot of people look at is they say, well, that's more income. That's more comfortable for me. I like that more because the income is a little bit higher. So that's guaranteed, and the term for that is guaranteed as well. You get the guarantee of that'll be there for the rest of your life, no matter how long you live. Some people ask, what if I die? What if I die? Will my spouse continue to get the income? The answer is yes. You can set up an annuity that will pay what we call joint income, which means it pays for you and it pays for your spouse. So if one of you passes away, the surviving spouse continues to get the income. That rate's a little bit lower. It's going to be closer to 7% if you're over 60, but it's still locked in. Whatever that rate is at the beginning of the contract, that rate is locked in. So you know before you even sign on the dotted line what your income is going to be now. If you defer it 1 year, you know what that income rate's going to be. If you defer it 2 years, you know what that income rate's going to be. If you defer it 3 years, you know automatically before you ever sign the contract what the interest and what the rate of income is going to be. So that provides substantial guarantees. So now you know for sure what your income is going to be in the future. So you can, what a lot of people will do is they'll roll their 401k at age 60, plan to turn on income at age 65, but now they know. They already have the contract in place and they say, I'm going to defer income until age 65 when I stop working. So now I turn at 65, I leave my employer, get my Medicare, turn on Social Security, and I turn on my income annuity that I had planned on doing. And now I have all those streams of income ready to roll, and they're guaranteed. They're guaranteed in the process. Uh, downside, the downside about the income annuity. Your rate is guaranteed, and your the term, the how long you're getting the income, that's guaranteed for the rest of your life. It never decreases, never goes down, uh, provided you bought the annuity that doesn't decrease in income. It never drops. The downside is that the money that you've used to purchase it will eventually get consumed in the annuity. So if you put $1 million in and you start getting $80,000 back per year, you get 80,000 year one, another 80, and it comes out of your million. 80,000 year two comes out of your million. 80,000 year three comes out of your million. So after about 12 years, you've been paid back all your money. So all the million that you put in, you've been paid back in the form of those $80,000 a year paychecks. After about 12 years, you've received all your million back. So you've been made whole. But the income keeps coming. It's the idea. The reason why they are purchased is even though you've been paid back all your money, the income is still there and it will continue to be there for as long as you live. And so you're like, wow, so I keep getting the 80,000 every year, even after I've been paid back all my million? And the answer is, yeah, that's the purpose of the contract. And that's why they are purchased for people entering retirement, is because now they'll never run out of money. That income stream will always be there for them, just like their social security, right next to their social security check. So you've turned it essentially into a personal type of pension, a stream of income that will always be there for the rest of your life. The downside is that that million gets consumed. So I have some people who say, well, I want to keep my million. I want to live on the interest to keep my million. That's door number one. Door number one is protect your million and get paid a percentage, either through a bond or through a multi-year annuity. The rate's just lower. So you have some options there. The benefit to door number two is the rate is higher and it's guaranteed forever. Well, not forever, for the rest of your life. And then there's door number three. Door number three type of annuity is a growth annuity. It's an annuity that will allow you to grow with certain indexes like the S&P, and it will pay anywhere between 0% if the market is down, all the way up to 10% or more if the market is up, depending on your cap rate. So, but your million is protected. Whatever money you're putting in there is protected. So, door number three is we protect your principal, and it's protected for as long as you keep the money in there, but the rate is not. The rate could be as low as zero if the market's down, but you won't lose money. You're guaranteed not to lose money when the market is down. And when the market's up, it could be up 10%. So if you're looking for a rate higher than 5%, but you could go a year without getting paid anything, then a growth annuity might be right for you. That's door number three. All of these are options other than real estate where you could take your retirement money and put it into a product. So let's review. You can buy dividend paying stocks. These are stocks that you buy and that will pay you a dividend usually every quarter, every 3 months, usually is when you're going to get paid your dividends. The benefit is that if things work out, you keep your stock value for years and years and years, and you get income from that stock for years and years and years. So for it, that your money actually is producing a stream of income. The downside is that the income is not guaranteed, the value, the amount of income is not guaranteed, and the stock value is not guaranteed. All of it could decrease. You could wind up losing value in the stock or in the income that you receive. Number two is bonds. Bonds is a place where you can put your money, a treasury bond or a municipal bond or a corporate bond, and those rates are the rate of return is dependent on whatever interest rates there are. So when the interest rates are high, the return of the bond is high. When the interest rate is low, the return of the bond is lower. And you can buy a longer bond or a shorter bond, however you want to lock in that rate. The upside is that your money is safe from stock market drops, and it'll always be there. It won't lose value necessarily. It's very, very uncommon for that to happen. And so that's the plus side. The downside is that the return rate is it fluctuates with the interest rates. So if next year, the year after, the interest rates are higher, that's good for you as far as income. If the interest rates are lower next year or the year after, then that could decrease your income. And then we talked about annuities. Annuities offer a version of a bond that will pay you a guaranteed rate for a period of time, sometimes as little as 3 years, usually 5 years. There's some that go a little bit longer, but those are all available again based on current interest rates. There are income annuities that guarantees you a higher rate for the rest of your life, no matter how long you live, but it uses up your retirement nest egg. It uses that to help provide that contract to you. And then there are growth annuities that will protect your million or protect your money, but the rate itself is not guaranteed. You could earn zero if the market's down. You could earn up 10% or more if the market's up, depending on your cap rate. Uh, so all these options are available. If you're nearing retirement and you're saying, okay, all of these sound really cool, like what's the time frame? Like if I'm going to retire in the next year, let's say, what's the time frame? Well, the sooner you talk to somebody and review your options, the better prepared you are. So I have some clients who are talking to me in their late 40s, and they're saying, okay, what am I going to do? There are a lot of people that have over $1 million in their 401k right now in their 40s, 49, 50, 51, 52. They have a lot of money, and so they're starting to plan. Some people are looking to retire early. Okay, what do I do? Can I retire early? If so, what are my options? Most people are going to target age 55 to 57. 55 because that's when you get Medicare. That's the soonest age you're allowed to get Medicare. And Medicare is the government subsidized medical insurance for retirees. That gives you the freedom to leave your employer's medical plan and jump on Medicare. Some people will delay to age 67 because they get a pay bump from Social Security at age 67. So some people will say, okay, I'll keep my employer plan, I'll stay working until age 67, then I'll retire, I'll get more money from Social Security, I'll get Medicare at that time, and then I'll make the switch. So that's when most people, I wouldn't say, I shouldn't say most, that's when a lot of people are planning their retirement. So if you're in your mid 60s and you're making this plan, uh, now is a good time to talk to somebody because you'll get to review your options. But even if you're 60 or even if you're 55 and you say, okay, what can I do? What a lot of people will do, let's say you're choosing a multi-year guarantee annuity, let's say, and you've got $1 million at age 60 in your 401k and you want to roll that over. Why do people do that? Some people might do that because they want to guarantee, they want to protect their money. And so there are some people that will do that to protect their $1 million or protect their whatever your nest egg is. They don't want it to drop because of a weird stock market year. The last one was in 2022, just 4 years ago, where the stock market S&P dropped 18%. That stinks, and we don't want to have that happen right before we enter retirement. So a lot of people will move, they'll put their money into roll it into an IRA annuity that will give them a guaranteed rate of return. If you're looking at income, let's say you want to choose door number two and you want to roll and use an income or use an income annuity. Doing that early will allow you to participate in a roll up. What a lot of insurance companies will do is they'll provide you with a roll up rate where you say, okay, if you start the annuity now at age 60, but you don't turn the income on until age 65, that's a 5 year deferral. You're going to defer for 5 years until you turn on income. We're going to roll up your income by a guaranteed percentage. 8%, 9%, 10%, rolling up every year. So that much like Social Security, every year you delay, the income gets bigger and bigger and bigger. So a lot of people will do that at age 60 so that by the time age 65 rolls around, they've had 5 years worth of rate roll up that they can now turn on at the right time. So, and a retirement specialist will be able to give you some guarantees on that. They'll be able to run some numbers, crunch some numbers for you, and show you here's exactly what your income will look like in 5 years, or 3 years, or 7 years, whatever your plan is. They'll be able to do that for you. And those quotes are guaranteed. They're guaranteed usually for a period of time until rates change, but that's one reason why a lot of people will do that. Another reason why a lot of people are looking at that now is because rates are high. Many of these returns, as far as uh, bonds and annuity rates and annuity cap rates, they are based on current interest rate environment, the current interest rates. So right now, interest rates are higher than they were in 21 and 22, just a few years ago. So now is a popular time for people to look at this because obviously looking at contracts like this when rates are higher are in your financial best interest versus looking at these contracts when rates are lower. So a lot of people can say, can I lock that rate in even though I'm not going to retire for a few more years? And the answer is yes, you can. So what does that mean for you? If you're nearing retirement, if you're, I'd say 45 or and over, and you're looking at getting prepared for your retirement, it's worth a conversation with a financial expert, someone that primarily specializes in retirement. Now, you can have you can have an investment guy, you can have a financial advisor, that's all good. But what I do specifically is helping people that are transitioning from their working years to their retirement years, and that usually happens in and around age 65. So when you're 55 and 60, talking to somebody and getting your plan lined out is not a bad idea. So talk to a financial expert, preferably one that specializes in retirement income, because that, I would say, my humble opinion, is the most important thing in retirement. It's not having money, it's having income. Even the richest among us, even the Warren Buffetts of the world, need a stream of income coming in, a stream of income coming in every month sufficient to cover our bills. That's what we need. And Social Security is good, but we usually need to supplement that with something else. And we use our retirement savings to do it. And in this episode, we've talked about some really cool options that you can use. There's others out there. There's other options that we just named here in this episode, a few that are most common, that are most popular for people who are looking to switch gears and take their retirement savings and start paying some income that you can then use to leave your employer and set sail to far off lands and try exotic foods and sleep in and new and quirky places and see northern lights and swim with dolphins and do all the stuff that we wanted to do when we were younger, but didn't because we were working. Now we can. We need income to be able to do that. That's what we're talking about today. Income, passive income in retirement. Thank you so much for your time for joining me on episode 3, and we hope you enjoyed and caught some good ideas. If you are curious about how much income you could be producing in retirement, if you're curious how much income you could be getting from your retirement savings, we can show you some numbers. You can shoot me an email, chris@retrieverfinancial.com, and we can help show you some numbers or point you in the right direction if you're looking for a certain type of investment vehicle that maybe we don't offer. We can certainly point you in the right direction of some people that we know and look at. But it's always fun. It's always fun to take a look and crunch some number. I'm a numbers cruncher, so I like doing it. But it's fun to say, hey, here's how much income you could get if you retired next year or the year after or the year after. And having that number is it's it's powerful because now you can start thinking, okay, if this is guaranteed and I know how much I'm getting from Social Security, maybe I can retire. Maybe retiring is something that I can actually do based on these guaranteed numbers that I have. So talk to a financial expert, talk to someone who specializes in retirement income, passive income in retirement, guaranteed income in retirement. They'll be able to show you some numbers. And if you don't have one, or if you want to work with us, with me directly, you can do so with at Chris at retirement or Retriever Financial, sorry, Chris at retrieverfinancial.com. Shoot me an email and we can get to talking more one-on-one about your money. Thank you so much for joining us on this episode of the Money by Chris podcast. We hope you had some fun. Again, I know it's a boring subject. There's nothing sexy about this type of work, but I promise you, once you have it set up, you'll be able to do the real fun stuff. The stuff that you really want to do is fueled by this boring work here, which is talking about your money and rates and stuff like that. This kind of stuff that'll just put you to sleep. If we get that knocked out, we get that locked in place, you start receiving that income. Now you can go do fun stuff. All the stuff that you really want to do, the stuff that is exciting, the stuff that you do want to wake up early for, like catching a plane or a cruise ship. That's what this does. So boring at first, but then locks in the fun later on. Thank you so much. Speaking of fun, I've had fun on this episode. Thank you so much for your time. Any questions that you have, any thoughts or comments, any ideas that you want to share, we would love to hear from you. Shoot me an email, Chris at retrieverfinancial.com. Retriever like the dog, financial like financial. Retrieverfinancial.com. Shoot me an email. Say hello. Let us know how you think, what you think about the show, and let us know what ideas, what subjects you would like us to talk to or talk about next time. And speaking of which, I will see you next time on the Money by Chris podcast. Thanks so much. Drive safe out there, guys.